Imagine waking up one day and discovering that the world's largest economic power, the one that prints the currency used in virtually all major global transactions, is bankrupt, not because it has no cash in hand, but because the very structure on which it was built can no longer support its own weight. Sounds unlikely, doesn't it? What if I told you that this scenario is closer than you think, and that the country that everyone points to as an alternative, China, may be sinking even faster, but silently? In recent years, the entire world has been watching the staggering rise in American debt. Every quarter, the graphs climb like endless mountains. Interest payments alone are now among the largest expenditures of the United States government, surpassing investments in education, infrastructure, and even defense. That's right. The most powerful country on the planet is basically paying to keep on being in debt. It's as if it were trapped in a game of roulette, where the bet is always higher than the last, and the house always wins. But make no mistake, the US is not playing this game blindly. It knows it has an ace up its sleeve that no one else does: the dollar. The most widely used, most trusted, most centrally banked currency in the world. This means the US can borrow more, for longer, and with fewer immediate consequences than any other country. In other words, it can play with fire because it controls the extinguisher. But even with this privilege, there is a limit. And the question that echoes behind the scenes of the financial world is disturbing. Who will pay this bill? Will it be the average worker, crushed by taxes? Will it be the consumer, punished by inflation? Or will it be our children, grandchildren, great-grandchildren, heirs of an economy that seems more like an elegant time bomb? While the West is anxious about this uncertainty, many look to the East for stability. And there is China, with its seemingly controlled charts, its official public debt at around 84% of GDP, less than the US's 123%, and much less than Japan's absurd 250%. A disciplined superpower, a symbol of state planning, a nation that not only avoids excessive debt, but also lends trillions to the rest of the world. During the most intense years of the Sino-US trade war, there was a silent shadow hanging over every negotiation. Beijing was holding hundreds of billions of dollars in US debt. What if it decided to sell them all at once? The message was clear. While the US begs, China hoards. While the West sinks into debt, the East hoards. But what if this is all an illusion? The surface may be calm, but what's lurking at the bottom of this pond? The truth is that you only have to dig a little beneath China's official numbers to find something much more chaotic. Something that threatens not only the myth of Asian stability, but also the entire narrative that China is poised to replace the United States as the dominant power. The first crack in this facade comes when we ask ourselves, what exactly counts as debt in China? The answer can be disconcerting. Unlike the United States, where almost all public debt is accounted for by the federal government, China hides its debt in layers upon layers of entities, local governments, state-owned enterprises, and mechanisms that function as fiscal black holes. The number that appears in official reports, 84% of GDP, is just the tip of an iceberg that no one can accurately measure. And here comes the paradox: a China that appears sober on the spreadsheets, but in practice is piling up debts everywhere to build ghost cities, finance high-speed railways that do not pay their costs, and sustain state-owned companies that operate on political, not economic, logic. While the West wonders whether the US will pass the point of no return, almost no one realizes that China may already have, only that it did so silently, without warning, with numbers that do not add up and data that no one can audit. So why this difference in perception? Why is American debt scary and Chinese debt not? Perhaps because we have become accustomed to seeing the United States as open. Everything is discussed, debated, published, and China as an enigma. Silence is sometimes mistaken for security. But what happens when the silence breaks? When, instead of official charts, we see alarming figures from independent institutions saying that China's real debt could be 3 times that of the United States? What happens when Chinese cities, where it takes 35 times the average wage to buy a home, start showing signs of economic collapse? What happens when the banks that finance this crazy growth realize that the payback may never come. These questions do not have simple answers. But one thing is clear: American debt is an explicit, debated, visible problem. Chinese debt is an implicit, hidden, latent problem. And that is precisely what makes it so dangerous. In the next few installments, we'll dive into this invisible web of Chinese debt. We'll explore how the government is hiding trillions across its provinces, how state-owned enterprises are acting as arms of an economic policy disguised as entrepreneurship, and how money printing, yes, the literal creation of wealth out of thin air, is fueling this silent house of cards. But before all this, it is worth reflecting. In a world where powers seem increasingly fragile, is there any country truly safe? Or are we all just choosing which collapse we prefer to see first? Imagine you have a neighbor. He lives in a modest house, nothing too flashy, always discreet. You know he has a few loans, like everyone else, but he seems to have everything under control. He pays his bills on time, never borrows money, and occasionally lends to others. But one day you discover that behind the locked basement door, he hides dozens of debt contracts in the name of companies registered in his name, loans taken out by relatives, favors exchanged with banks, and that, in fact, he owes just as much as that other noisy, wasteful neighbor that everyone always criticized. This is the real picture of China today. While the West points the finger at the United States and screams, "Crisis," China smiles calmly and shows its magic number, 84% of GDP. That is the official value of China's public debt. Low, disciplined, civilized. But it is only that way because no one is looking where they really should. China hides its debt like a skilled illusionist, not by denying that it exists, but by shifting its gaze elsewhere. The magic happens in the provinces. Each of China's 31 provinces functions almost like a small country, and these provinces take on debt in the name of regional development. But unlike a federal government that publishes every penny in its public accounts, these provinces operate with disconcerting opacity. Now imagine that you live in one of these regions. Let's take Guizhou province as an example. It is one of the poorest in China, but in the last 15 years, it has built more infrastructure than many entire countries. Bridges, highways, high-speed trains, industrial zones. It is almost impossible to walk around Guizhou without seeing some gigantic construction project. But all of this was done with borrowed money, lots of money. In 2023, the province declared that it could no longer pay the interest on its debt and asked Beijing for help. It was not the only one. Now, let's add up all these provinces. Conservative estimates indicate that local government debts already exceed $12.6 trillion. That alone is more than 76% of China's GDP. And we haven't even begun to talk about state-owned companies. This is where the plot starts to feel like an economic espionage thriller. Companies that appear to be private, but are 100% government-owned, or at least controlled, borrow money as if they were regular businesses, but with one twist: if it goes wrong, the government covers. The best-known example is that of China State Construction and Engineering Corporation, the largest construction company in the world. It operates profitably. It's true, but its mission is not to please shareholders. It's to please the party. When the government says, build an airport in the middle of the desert, or build a city in the middle of nowhere in North Africa, they obey. And that's where the problem comes in. These mega projects don't always yield financial returns, but the debt is there. And since no one considers this debt to be the government, it doesn't count toward the magic number of 84%. Now breathe, because the real number, adding up debts of local governments, state-owned companies, public investment funds, and hidden entities, easily exceeds $30 trillion. This is more than 300% of China's GDP, and it could be even more if the country's official growth figures are inflated, as many economists believe. But why does that matter to you, who are far away? Because this type of debt has repercussions all over the world. If you have ever bought a cheaper cell phone, used an app made by a Chinese company, or even seen your job threatened by more competitive products from Asia, you have been touched by this economy. And if this system starts to collapse, The waves of this collapse will travel across oceans. Think about it. Have you ever seen a new, modern building full of apartments for sale, but completely empty? In China, this is a common scenario. Thousands of real estate projects were built not because there was demand, but because there was credit, cheap credit, easy money. And while this generated growth on paper, real life continued without really benefiting. And here is a question that touches us all. To what extent is growth worth it if it is built on promises that may never be fulfilled? Imagine living in a city with wide streets, brand new avenues and shiny buildings, but no jobs, no shops, no neighbors. This is the daily life of many Chinese families who have invested their savings in real estate that is now worth less than half of what they paid for. Families who have saved for decades, who have given up small luxuries, all to secure their future, and ended up with ghost apartments in ghost towns. And the scariest thing? Most people don't even know that all of this is tied to a web of invisible debts. The illusion is still standing, it's starting to bite, because the bill always comes. And the question remains, when China stops hiding these debts under rugs and boxes, what will be left? And most importantly, who will clean up the mess? Perhaps the cruelest thing about this story is that, unlike in the United States, where the problem is debated, exposed, even politicized, in China, no one can ask these questions out loud. Economists who try to investigate these figures are silent. Foreign reporters are expelled. Data disappeared, and that, in itself, says a lot. But time demands what transparency does not demand. And when that happens, there will be little point in trying to hide it. The structure is already being corroded from within, and perhaps, when it collapses, no one will be able to sustain the narrative that China is the safe alternative. Now, if you've come this far, it's because you know how important this topic is. The economy may seem like something distant, but it impacts the price of your food, the stability of your job, the value of your money, and even world peace. And understanding what's behind official speeches is more than just curiosity. It's survival. If this content made you think, surprised you, or left you with that feeling of, I need to know more, then leave your like and subscribe to the channel now. This helps our work a lot and shows that it's worth making videos that go beyond the surface. And in the next part, we'll reveal the most disconcerting secret of all: how China managed to print more money than any other country in the modern world, and why it hasn't blown up in their faces yet. The answer is more bizarre than you might think, and the consequence may already be on its way. See you there. What if you could borrow money whenever you wanted, for as long as you wanted, without anyone asking you for an explanation? Sounds like a dream, right? For China, that has been the reality. A country that should be paying high interest on its debt. After all, it carries risks, opacity, and a history of political interventions, but, curiously, pays less than the United States. How is that possible? Today, if a government wants to borrow money, it needs to attract investors. It needs to show stability, transparency, and return. And the riskier the money, the more expensive it becomes. That's how it works for you, for me, for companies, and for countries. But China has broken that rule. A 10-year U.S. bond, still considered one of the safest investments in the world, yields about 4.5% per year. An equivalent bond from China, just 1.7%. That's almost 3 times less return for much more risk. Why would investors accept this? This is the first clue that China is not playing the same game as the rest of the world. And perhaps it is not even on the same board. The most immediate explanation is capital control. In China, you can't just take your money and invest it abroad. There's an invisible wall between the yuan and the rest of the global financial system, and it's solid. Chinese institutions like banks or pension funds don't have the freedom to put their billions into U.S. treasuries or Apple stocks. They have to invest it right there in whatever's available in their backyard. And what's available mostly is Chinese debt. But what about the stock market? Isn't that the natural alternative? Here comes the second setback. Despite all of China's economic growth over the past few decades, the country's stock market is disappointing, to say the least. Since 2000, China's stock market has appreciated by less than 100%. In the same period, the U.S. stock market has grown by more than 300%. And this is not a statistical detail. It is a profound reflection of how the Chinese economy operates. Why has a nation that has grown so quickly failed to get its stock market off the ground? The answer lies in the very concept of enterprise in China. Many listed companies are state-owned or have strong ties to the government. This means that for these companies, generating profits is not their priority. The priority is to implement public policy, building where the party tells them to, hiring who the party recommends, selling at the price the party sets, and even private companies are private to some extent. Remember when Jack Ma, the founder of Alibaba, dared to publicly criticize the Chinese financial system? Within days, Ant Financial's billion-dollar IPO was canceled. Jack Ma disappeared from public view. International investors fled in silence, and it sent a clear message. You can be a billionaire in China as long as you don't forget who's in charge. But let's get away from the numbers for a moment. Let's think about something closer to our reality. Have you ever tried to save money in a country where everything gets more expensive all the time? It's hard, right? Now imagine living in a country where prices barely change, where you can save for years and your money will still be worth practically the same. Sounds great, but it comes at a cost. In China, consumer prices have been stagnant for more than 2 decades. This has a name: deflation. It sounds like a blessing, but it is a curse in disguise. When people believe that prices will remain low, they postpone purchases. They do not invest. They do not consume. And when no one consumes, no one produces. And when no one produces, no one hires. The economy enters a slow, stuck cycle, an economy frozen in time. So why does China continue to print money at unprecedented levels? Between 2000 and 2019, the United States tripled its monetary base. This was an immense growth, especially during the 2008 crisis and the pandemic. But China went further. It multiplied its monetary base 16 times. It increased it 6-fold. It injected an amount of money into the economy that in any other part of the world would cause runaway inflation. But in China, nothing. How is this possible? The explanation lies, once again, in the behavior of the Chinese people. They are among the most frugal on the planet. While in the U.S., household consumption represents almost 70% of GDP, in China, this figure is only 39%. That is less than half. In a country that has experienced explosive growth for decades, citizens have continued to save as if it were still the 1980s. But that doesn't solve everything. Because if people don't consume, if the stock market isn't attractive, and if all the credit is concentrated in the hands of those who don't have to be accountable, then where is all this money going? Here comes the final blow to this part of the story. It's going into real estate. China's real estate sector is now the largest in the world. More than that, it is the main destination for Chinese household saving. And this has created an unprecedented problem. When you can't trust the stock market, the banks, or the government, you buy bricks, apartment, land, entire cities, if you can. But now these cities are empty, apartments are vacant, and prices have reached unbelievable levels. In Beijing, for example, the average price of a property is equivalent to 35 times the average annual salary. Compare that to Los Angeles, 7.5 times, London, 19 times, or Sydney, 13 times. And you get the idea of the bubble. But what sustains a bubble in the end is the belief that it will never burst. Does this belief still hold? This is the tipping point. China has created an ecosystem where money is cheap but poorly used, where investment does not mean efficiency but obedience, where credit does not stimulate innovation but construction, where the monetary base grows as if there were no tomorrow, and yet people save every penny as if tomorrow were certain. But what if tomorrow doesn't come? What if banks suddenly realize they are exposed to unpayable loan? What if state-owned companies stop generating profit? What if investors, even if trapped within the system, lose faith? What happens when the greatest financial experiment of the century starts to show signs of fatigue? We may be about to find out, and when we do, it won't just be a Chinese crisis. It will be a global wave, hitting trade, exchange rates, investment, and, most importantly, confidence. If this sounds unbelievable to you, wait until you see how this all ties into China's biggest asset, real estate. In the next part, we'll show you how the debt-based growth model is on the brink of collapse and how, little by little, this silent collapse is already undermining the foundation of the world's second-largest economy. You won't want to miss it. See you there. If there is a silent symbol of China's economic rise in recent decades, it is not in the luxury cars or the stock market. It is in the lit windows, or rather, in the ones that are not. At night, just fly over some of China's major cities to see a ghostly spectacle. Hundreds of impeccable, modern, imposing skyscrapers, completely dark, lifeless, without residents, entire buildings built for a future that has not arrived, or that may never arrive. These structures are informally referred to as ghost cities, and there are thousands, literally. Recent studies indicate that around 65 million apartments in China are empty. That's more than the total number of homes in the whole of Germany. In practical terms, China has built enough cities to house a population equivalent to that of the United Kingdom, but no one has moved there. But why would anyone build a city with no inhabitants? Why invest billions in cement and glass, where there are no schools, shops, hospitals, or jobs? The answer is simple and disconcerting, because it was the only safe place to put the money. Remember what we saw earlier? The average Chinese person doesn't trust the stock market, doesn't have the freedom to invest abroad, and isn't encouraged to consume. With one of the highest savings rates in the world, families save obsessively. And the destination of these savings, almost inevitably, is real estate. Investing in real estate has become a ritual of stability. Buying a home is not just a financial choice, it is proof of family value, a prerequisite for marriage, a future inheritance. And this culture, combined with the lack of investment alternatives, has created a perfect storm. Real estate prices seem to go up forever, and when everyone believes that prices will only go up, there are no limits to optimism or to debt. Time to take a break. Let's recap. China grew fast, very fast. To maintain this growth, it invested heavily in infrastructure. When it ran out of money, it borrowed. When it could no longer lend, it created money. And when consumption did not keep up with growth, the country poured this capital into real estate. Houses, buildings, cities. Real estate became the backbone of growth, but a backbone built on excessive debt, irrational speculation, and artificially sustained demand. One name became world famous because of this: Evergrande. The Chinese real estate giant has become synonymous with crisis. It was once China's second-largest developer, with more than 1,300 projects in 280 cities. For years, the company expanded without limits, financing its projects with cascading loans. When it began to struggle to pay its creditors, confidence evaporated. In 2021, it declared one of the largest corporate defaults in history. Millions of families who had invested their entire savings in apartments still under construction were left without a response. Workers from abandoned construction sites protested in the streets. Small suppliers went bankrupt. Investors lost everything. And the Chinese government, which until then had encouraged this growth, hesitated. Should it save? Should it let it go bankrupt? Should it intervene? Or should it wait? It was a moment of revelation. The house of cards began to shake. And what happened to Evergrande was not an isolated case. The company's collapse served as a warning to hundreds of other developers who operated with the same logic, building today with tomorrow's money. But tomorrow arrived, and the buyers disappeared. Credit dried up. Prices began to fall. What was certain became doubt. What was an asset became a risk. Pause for a provocation. How many times have you heard that real estate is a safe investment? What if what guarantees this safety is precisely the consumption that no longer exists? The frightening thing is that the crisis is not limited to vacant properties. It is rippling across every sector of the Chinese economy. Banks that overlent are starting to post losses. Local governments that relied on land sales to maintain their revenue are going bankrupt. And consumers, up to their eyeballs in mortgages on apartments that have not yet been delivered, have stopped spending on everything else. This toxic cycle leads to an increasingly visible phenomenon: the stagnation of consumption. In most countries, Household consumption is the driving force behind the economy. In the US, for example, it accounts for 68% of GDP. In China, only 39%. This means that the Chinese economy is not growing because people are buying more, eating out, traveling, and changing their cell phone. It is growing because the government is injecting money, and much of that money ends up in bricks and mortar. And do you know what happens when no one buys? Prices stop rising. And when prices stop rising, no one invests. This is the perverse cycle of deflation, something that China is facing with increasing intensity. In 2023, China's consumer price index fell for the first time in years. What seems like a victory against inflation is actually a silent warning. There is no demand, and if there is no demand, why continue producing? Because, for the government, stopping is admitting failure, and failure does not go hand in hand with stability. So, even with a slowing economy, China continues to invest, creating artificial jobs, financing projects that will not be used, feeding companies that cannot sustain themselves, printing money that does not circulate, all to maintain an appearance of growth. A growth that increasingly looks like an illusion. Moment of reflection when you look at a city like Xiong'an, planned to be the city of the future, with wide streets, fast trains, and gleaming buildings, everything looks promising. But when you walk down those same streets and hear only the echo of your own footsteps, you realize something is off. Modernity is there, but life has not arrived. And it's not just everyday life that's missing. It's sustainability. The money invested there doesn't come back. The investment doesn't translate into productivity. The debts incurred to build these places pile up. And what should be a solution for growth becomes a burden that the economy no longer knows how to bear. Real estate, once the symbol of the Chinese miracle, now threatens to become its Achilles heel. And what makes it all the more delicate is the fact that, even in the face of this scenario, most people, inside and outside China, still don't realize the full risk, because the official narrative remains the same, because the graphs are still rising, because the city lights are still shining, even if no one is turning on the switches inside. But like every bubble, this one also has a limit, and maybe we are already very close to it. In the next part, we'll dive into what makes this model unsustainable, where money comes from, because an economy that thrives on easy credit and money printing can survive for a while, but not forever. We'll look at how China has expanded its monetary base like never before, and why the fact that inflation hasn't arrived yet may be a harbinger of something much worse, something that affects not only China, but the balance of the entire world. By now, the scenario no longer seems so distant. It's not just about trillions of dollars or colorful line charts. It's about a complex, silent, and deeply unstable structure built on invisible debt, unproductive investment, and carefully staged confidence. The Chinese economy, which for decades was seen as an unstoppable locomotive, now reveals itself as a kind of hall of mirrors, shiny on the outside, but full of twists and turns on the inside. Over the past few parts, we've seen how this debt has been spread across subterranean layers: provincial governments, state-owned enterprises, controlled banks, shadow real estate projects. We've seen that the money has often simply appeared, printed, multiplied, moved from one branch of government to another, without ever passing through the hands of the population. We've seen that the real estate bubble is not just an anomaly, but the very heart of a model that grew by betting on constant expansion, even without real demand. And we've seen that the Chinese people, incredibly disciplined, don't consume enough to sustain this model, which, paradoxically, is what has allowed it to survive until now. But now it's time to answer the question that has been pending since the beginning. Is all this sustainable? Or are we watching, in slow motion, the prelude to a collapse? The short answer is, there is no imminent collapse yet. But there are visible cracks, and those cracks are widening. What is holding China together today is not economic equilibrium, but a highly volatile combination of factors: absolute control of information, the ability to print money without generating inflation, and a population that, for now, continues to silently obey. But silence comes at a cost, and it's getting louder. Let's think for a moment about the metaphor of debt as a rubber band. You can stretch it a lot, especially if it's strong. But at some point, it either snaps or snaps back too hard. And today, China is stretching that rubber band in every direction. With more than 300% of its GDP in debt, and potentially as much as 450% if we go by unofficial data, the country has already surpassed the limits that, in other nations, would mean a state of economic emergency. The difference? There. No one is allowed to use that term. But there is one final fact that changes the perspective. According to the Chinese Academy of Social Sciences, the Chinese government would have a positive net worth of about $40 trillion. This means that, in theory, China could sell assets, land, companies, infrastructure, and pay off a good portion of this debt. And it is true. Unlike the United States, where the government has few liquid assets, the Chinese state owns almost everything: land, public services, the largest companies, even the data that circulates on the internet. The problem is that a good portion of these assets cannot be sold without destroying the political system itself, who created them. China is rich, yes, but that wealth is trapped, and what is loose is debt. So what's left? What remains is time. What remains is the ability to continue managing this juggling act without dropping any balls. What remains is the ability to keep inflation low, credit under control, and the population obedient, all at the same time. And that, let's face it, is a task that borders on the impossible. And here comes the most profound reflection of all. Maybe what we are seeing is not just a question of economics, but of system. In the United States, the problems are obvious: rising debt, uncontrolled consumption, inflation that is hard to contain, and a political machine that is stuck in a rut that keeps pushing crises under the rug. But democracy allows these problems to be exposed, criticized, and debated. This doesn't solve everything, but at least it prevents the bubble from growing in the dark. In China, the problems are hidden, but they are growing more systematically. The lack of opposition, of a free press, of transparency and data creates an environment where everything seems under control, until it isn't. And in this silent clash between two imperfect models, perhaps there is no winner, just loser at different times. So the final question we are left with is, what happens when the country that supports part of the global economy, including buying the debt of others, discovers that its own debt is unpayable? And most importantly, is the world ready for this? This video series was created to shed light on a topic that is often shrouded in fog and difficult numbered. But the goal here was never just to inform, it was to provoke. Because understanding what goes on behind the walls of the world's second-largest economy is essential for anyone who wants to understand the 21st century and the future that is taking shape, often without us even realizing it. If you've come this far, it's because you value true knowledge. So here's our request from the bottom of our hearts. Like this video, subscribe to the channel, and comment below what surprised you most about this script. Your engagement not only helps us reach more people, but also shows us that it's worth continuing to delve into deep topics with courage and honesty. And I'll leave you with an invitation. In the next video, we're going to explore a subject that seems like something out of a science fiction movie, but is frighteningly real: how some nations are using foreign debt as a weapon of silent domination in more fragile countries. What's the name of this? 21st century imperialism. And believe me, it doesn't use canon. It uses contracts. Thank you so much for watching until the end. See you in the next episode. Until then, and be careful what you believe to be true. Sometimes what's visible is just the part they let you see.